Hey, what's up guys? John here. The Federal Reserve just increased interest rates 75 basis points for the fourth time, the fourth straight meeting. Now, the Federal Reserve approved a fourth straight hike, the 3/4 of a point on Wednesday, today, as part of its aggressive battle to bring down white-hot inflation that is plaguing the U.S. economy. The supersized hike brings the central bank's benchmark lending rate to a new 3.75 to 4%. That's the highest Fed's fund rate since 2008. Wednesday's decision, which comes at the end of a two-day policy meeting of the Federal Open Market Committee, marks the Fed's toughest policy move since the 1980s and will likely deepen the economic pain for millions of American businesses and households by pushing up the cost of borrowing even further. Now, yesterday's jobs numbers came out, and those job numbers were very strong. They're saying that that's a problem for inflation. I believe what we're likely going to start to see is the next meeting, we're going to probably get 50 basis points, another hike. And then I think we're going to start to see more and more and more hikes to where we could start to potentially see a 10% 30-year fixed rate mortgage, 10%. Now, right now, we're in the mid-sevens. If you have perfect credit, maybe you're 7.5%. If you have average credit in America, you're probably somewhere around 8% or 7.9% for a 30-year fixed, which is huge because 6 months ago, a year ago, you were 3%, 2.5%. Now, what is this going to look like? Because when we look at the housing market, what did we see? What did we see over the last couple of years? The surge in home flippers, real estate investors, real estate speculators, people that were Airbnb, a lot of activity. Real estate felt like it was a safe haven. It was a hedge against inflation. However, what does this look like with a lot of the investors that bought properties with short-term bridge debt or hard money? It's going to make things very, very challenging when it comes time to refinance these properties to get into stable long-term debt if the price to borrow money doubled. And we're already starting to see right now a lot of mortgage lenders tighten up their lending restrictions, making it much more challenging for people to obtain financing. I was speaking with a hedge fund buddy of mine just a couple hours ago, and I was asking if he had any mortgage lender friends that had credit repair clients for my business, and he said, almost all of my mortgage buddies are no longer in the business. And that's unbelievable. And we're reading these headlines such as Wells Fargo and Better.com and a lot of these companies talking about issuing mass layoffs. So when you start to see it inside of your own circles, it becomes much more real. For example, this article here, they're talking about the Las Vegas, and please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on in the housing market. Now, Las Vegas has a really kind of a special place for me because in 2008, one of my clients sold her home in a short sale for $80,000. 2 years before that, when the Vegas housing market was booming, she bought it for $365,000. So it lost like almost 80-90% of its value during that crash. Las Vegas is a very boom-bust market, very similar to a lot of markets. Historically, it's been Miami. Now I believe it's going to be Austin, Texas. It's going to be some of these markets that saw huge surges of activity. We're going to start to see this pull back. Austin, for example, sales volume has already dropped 58%. Look at this. So housing market activity is crashing, and it threatens to push the U.S. into recession just like it did in 1981 and 2008. The go-to line this year from analysts and economists is that the Fed will push until something breaks. Increasingly, it's looking like that something might be the weakening U.S. housing market. Las Vegas is one of those leading indicators for home price action in the housing market like we saw in 2008. And the recent frenzy, we are absolutely feeling the heat here. The buyer pool has, for the most part, dried up. But it's not just the bubbly markets like Vegas and Boise that are feeling the pain. This housing market downturn is picking up steam nationwide. In fact, as of last week, mortgage purchase applications are down to 38% on a year-over-year basis. That marks the lowest since 2014. Simply put, housing market activity is crashing. Let's be clear though, the crash in housing activity, or as the Fed Chair Jerome Powell calls it, a difficult correction, didn't appear out of thin air. It's all by design. The Federal Reserve flipped into inflation fighting mode this spring with hopes of elevated interest rates would cause the activity to slump in rate sensitive sectors like housing. The Fed's reasoning for the slowing the U.S. housing market boils down to two words: demand destruction. Historically speaking, mortgage rates spike as soon as central banks go into inflation fighting mode. The mortgage rate shock causes sales for both existing and new homes to fall as builders cut back demand for both commodities like lumber and durable goods like refrigerators, then declines It also causes real estate and construction layoffs. Those economic contractions then quickly spread throughout the rest of the economy and, in theory, help to weaken labor markets and tighten high inflation. Now, you look at this data, it says realtors are feeling the pain big time as well. I put in a call to the Greater Las Vegas Association of Realtors, and the employee I spoke with said that they were averaging about 300 new realtors every month, 300 new members every month, so about 10 a day. This month, she had estimated 120. However, she has been processing about 30 realtor withdrawals a day. So they're losing about 900 realtors a month, gaining 120. That means that every day, 30 real estate agents in Vegas alone are calling it quits. Now let's rewind. And right now there's 1.596 million real estate agents. In 2008, 2009, there was about 1.1 million, 1,050,000, around that range. So they lost about 40% of their realtors. I believe that we could start to see that go back again. I think we're going to start to see a lot of realtors that were used to and accustomed to easy transactions. I mean, it really didn't take much skill to sell a property the last couple of years. You simply took some pictures on your cell phone, you uploaded it into Zillow, and before you know it, you had 10 or 20 offers on a property. That is now changing. I believe we're going to start to see a lot of realtors say, you know what, this is really hard, this is really challenging, and we're going to let see a lot more realtors desperate for the sale, reducing commissions, taking away the real value of being a real estate agent for a lot of the newer agents that jumped in when everything was good. Now let's rewind back to this article. An analyst said the Fed will push till something breaks. They're implying the Fed's inflation campaign is going to continue until either inflation abates or something pushes the economy into a recession. That something could be distress in the bond market or perhaps liquidity issues in major financial firms, but there's also growing concern that something could be the housing market. In 1981 and 2008, there's nothing unusual about housing market downturns helping to trigger a recession. Look no further than economist Edward Lemar's 2007 paper titled "Housing is the Business Cycle." Lemar's found that 80% of post-World War II recessions came after substantial housing slowdowns. But when analysts talk about the housing market that breaks, they're talking about a housing downturn, not just helping to cause recessions, but by being the underlying cause. The most notorious historical example is 1981 and 2008. Back in the early 1980s, this is the other thing. We're so addicted to cheap money. If we start going back to Volcker's era, where we start seeing double-digit interest rates on 30-year fixed, we are going to start to see not just a traditional crash. We're going to see something far worse than 2008. We're going to see a situation in which we're having employers issuing massive layoffs. People now they're locked into these properties. A lot of people say, hey, they have cheap debt. They're not going to sell if they have 30-year fixed rate debt at 3%. But if they lose their job, they're not going to be able to refinance these properties if the adjacent comparables in their neighborhood are selling at much lower valuations than in which they purchased. They don't have equity. They're not going to be able to get a refinance. Even if they could get it, they wouldn't qualify because they lost their job. And so what is that going to look like? More and more and more inventory. Higher interest rates equals higher opportunity for smart and savvy real estate investors to take advantage of distress. And I think that's what we're going to be entering in. I think over the next year, potentially two, we could see interest rates far above what most people can comprehend. And with that is going to come a huge once-in-a-lifetime opportunity to make a ton of money. I believe that we have between 1 and 3 years to make a lot of money. I think what's ultimately going to happen, 2027, 2028, we're going to start seeing automation and robotics and all that become more normalized. And at that time, you don't want to be out there competing against that. You want to make as much money as you possibly can. Position yourself as well as you can. Use that capital. Build out companies, build out infrastructure to where you become basically untouchable during all that change. That change is coming. And I believe it's going to be forced as they start to increase interest rates. What's ultimately going to happen? The cost to borrow money is going to continue to increase, and people are going to be looking for ways to save money. One of the easiest ways to save money is automation. And it's going to save money because you're going to be able to cut back on jobs and expenses. I believe that's what's ultimately going to happen. We're getting pushed into this system, this cycle, to where it's going to be harder for small businesses to remain profitable, and it's going to be easier for large corporations to be pushed into automation. What do you think? Drop it below, hit the like button, subscribe here. Subscribe also to my second channel. It's an interactive call-in show and a podcast. If you need help fixing your credit, we'd love to give you a free consultation at CashNow.Video. That's CashNow.Video. Also, LinkedIn, Twitter, Instagram, and TikTok up in the banner, and I'll catch you guys in the next video.